It's the morning drive at Mira Business FM. I'm Tim Elliott, and we're talking tax now. So, here's the story, the implications of the proposed UK exit tax. I'm joined to talk this through by an expert. She's a financial expert at the Michele Carby practice under the Holborn Assets Group, which is a financial advisory, international financial advisory. Michele, lovely to meet you. Nice to have you here.
Thanks, Tim. Nice to be here.
Good to have you. Look, this is I said this just now, it's a very UK-centric story, but I think it's a really interesting story given the background. If you consider post-COVID, anywhere in the world, but in this case in the United Kingdom, the change in government from right to left in terms of the political spectrum, tax rises necessary to pay for COVID. Much is being written about wealthy entrepreneurs making their way abroad to more favourable tax positions, tax havens even. So here we are, really, and the 2025 budget is looming. It's November the 26th. Financial experts are kind of urgently assessing how this proposed rumoured exit tax measures targeting high net worth individuals and maybe capital gains could redefine wealth planning for UK expats. So it's a narrow window for action potentially. Lots of people fretting about this. Let's start with what an exit tax is. Can you first of all kind of define what it means before we go any further?
Thanks, Tim. In this context, it's not going to be a £500, toll charge at the airport every time, you arrive or leave. It's not that type of exit tax.
Good to know.
It's rather being modelled currently by the Labour government in the UK, and that's where the rumours are coming from. So the exit tax, or how they'd like to frame it, is a settling up charge, because that sounds a lot softer than a penalty or a tax.
It does.
That sounds quite punitive, but a settling up charge does sound a little bit softer and nicer on the ears rather than a tax or a penalty. And what they're currently considering is levying this 20% settling up charge on high net worth individuals, aimed specifically at entrepreneurs, business people, and investors. That's the target audience for this particular tax that's being considered right now.
Okay, so as far as we know, it's being considered. It's been a rumour. Rumours come from somewhere, of course they do. But it is much more than a rumour, and you expect something on November the 26th to be announced.
We certainly do. It was published on the 1st of November by well-respected press in the UK.
Yeah.
Publications like The Independent, The Guardian, and The Times. They all published this 20% settling up tax and went through quite a bit of detail on that particular day. The rumours, they suggest, came from the modelling that's being run right now by Rachel Rees and her team in the UK. And since it's coming from a trusted source, people are sitting up and paying attention and thinking the chances are pretty good that we're going to see this announced in the budget on the 26th.
Okay, so it looks like something of this order is going to be announced. It doesn't take a genius, and I certainly am not one, to see the aim is to prevent successful entrepreneurs shifting wealth, cashing out, of course. Big headline recently was, I guess, really the Revolut co-founder Nikolai Storonsky's move to Dubai here. It kind of illustrates the concern, I suppose. What's the current tax situation for someone who leaves the UK for sunnier climes?
Currently, as things stand, you have a 5-year rule that is in place, which means you can move abroad to tax havens or lower tax jurisdictions. The most popular currently being used in all headlines is Dubai, but other options do exist, like Monaco and the Cayman Islands. I think everybody's forgotten about the other options.
The other brands are available, aren't they? Yeah.
Exactly. And everybody seems to be flying to Dubai or just considering Dubai in totality. But it means that you could move abroad to a tax haven and dispose of your UK assets once you're abroad, provided you don't return for 5 years back to the UK.
Right.
So that's a very strict consideration. If you return back to the UK during the 5 years, it will be that you'll be taxed as if you never left.
And is that how much time, if you went back for, I don't know, a wedding, a funeral, whatever, that's not included?
That's not included. We're talking
What's the
about
time period?
moving back to become tax resident.
Okay, so you can spend a certain amount of time back.
You can.
Right.
You can.
You've talked about, it looks like it's going to be a 20% levy on unrealised capital gains. That's the theory. Are there any more details of, I'm asking you for details of rumours, but you know what I
Yes,
mean.
details of rumours.
Yeah.
What we understand from the modelling currently being proposed is that it's on the value of the company. So, for example, if you bought a business at £1 million and you sold it at £5 million, the profit is 4 million.
Right.
Apply the 20% to that 4 million, 800,000 pounds worth of taxation will be levied. Now, they're also talking about a deferment mechanism, which might be quite attractive. So they're not saying you'd have to pay the 800,000 in that example on the day you leave. Rather, they're allowing a deferment mechanism within the modeling that they're doing to say when you sell it, that's the amount of tax that will be payable from the sale. So they're making the calculation on the day that you leave, but the tax will only be payable once that business is sold, for example. So once the gain is actually realized.
Okay. Why is it being considered at this point? What are the mechanics of the reason that the Chancellor, Rachel Reeves, is going to put this in place?
Well, if you consider the current position in the UK, they have a very big fiscal gap to plug. Rumoured $20 to $30 billion worth of black hole. The settling up charge will potentially realize £2 billion. That's quite an attractive number to the UK government, and it's not against their manifesto pledge, whereas raising income tax and raising VAT are obvious options, but that would go against their manifesto that they put in place at the last election. So tackling something like this and bringing in the settling up charge would be something that they haven't spoken about before, but is in place with other G7 countries around the world. And so they can actually see it working because France, for example, and Germany have this model and it works very effectively. Canada do something similar, and the US do something similar if you give up your US citizenship.
It also, I guess, it kind of fits along party lines. It fits to principles, doesn't it? If you're on the left of the spectrum, so I can understand that. But is this a first step towards taxing the more wealthy, high net worth individuals, the wealthier, I don't know, corporations, as they're seen? Is that maybe
It is. I
where
think
it's headed?
absolutely, Tim. I think it's definitely a step in that direction because I think people feel that if you tax the wealthy, only those people are affected. It doesn't affect the masses. So potentially not too much of a vote loser, in inverted commas.
Yeah.
And perhaps more of a vote winner because you're not affecting everyone across the piece.
Well, to the ordinary working man, the average Joe, if you like, it could be pretty popular.
Absolutely. And the next changes that potentially could happen is once they've tackled this, they could potentially look at restricting pension contributions, for example, because right now you have £60,000 a year that you can pay in pension contributions and get 40% tax relief for high rate taxpayers. So there are other things that they can do, and that this may be the precursor to other things that they can tinker with in the future.
Okay. We hear so much in the UK press, and these are in international stories. Mr. Revolut, co-founder, is obviously the big story, but it's a good illustration. There is so much made of millionaires are leaving the UK, everybody's fleeing, the Labour government are doing this. I just wonder how much, first of all, how much that's a thing. Really, in your opinion, again, I'm asking for rumours and opinions and speculation, everything else. But it is interesting. And could this also stem this stream of people leaving, ensuring that high earners remain UK resident income taxpayers, and whether those determined to go would still go and kind of pay up as you leave, kind of thing?
Look, it's a difficult one, Tim. I think one does have to consider that these wealthy business owners employ a lot of people and they pay a lot of tax in the UK. And consider this, that if these wealthy business owners had to shut up shop and leave tomorrow, for example, how many people does that add to the unemployment numbers, and also reduces the income tax that and VAT that those businesses would otherwise be paying? And that's lost revenue and collateral damage, for want of better words.
Well, it is. It's also, you said something there. If a chancellor of a country is looking to make up a 20 to 30 billion hole, so you've got to find that money from somewhere. And one of the ways is a tax like this, where you raise 2 billion. £2 billion, is a great deal of money. Times that by 5, you get the dirhams. It's 10 billion dirhams. But it's not going to fill a 20 to 30 billion dirham hole, is it? It feels to me, drop in the ocean is a little bit extreme, but it's nowhere near enough.
It isn't, but it is a big number towards a big number.
And that's how it's seen, I guess.
Absolutely.
Right.
Absolutely. And there are other changes that the UK government are considering to plug that hole. They're considering all kinds of other options in order to get that fiscal gap plugged. But it is a drop in the ocean if you consider it, and 2 billion against 20 or 30 billion shortfall doesn't seem very much, but it's a step in the right direction.
Okay. Is this just for people heading to low tax jurisdictions, or could this potentially affect people leaving for places with taxes, a similar regime to the UK, if you like?
Well, there are double taxation agreements in place with a number of countries. So the no tax or lower tax jurisdictions, places like Dubai, Monaco, the Cayman Islands, are obviously no tax jurisdictions when it comes to capital gains tax, for example. They also have double taxation agreements in place with the UK, which means you'll only be taxed in one jurisdiction. So if somebody moved to Portugal, for example, they would have a consideration towards tax just at a much lower level.
Right.
So you'll either pay it in Portugal or you'll pay it in the UK, but it will be paid somewhere. But it's important to understand that whilst these are headlines right now and considerations, you do have time to put mechanisms in place. Don't just rush for the exit door and think that's the best strategy, because the UK government are a little bit smarter than most laymen. So rather, talk to people that are informed, speak to your financial advisors, your tax advisors, and get proper financial planning advice before you make rash decisions.
It's such good advice, that it really is, because it's very easy, isn't it? We're bombarded by media, and it's not just reading a paper anymore. It's on your phone screen. It hits you as soon as you wake up in the morning. I'm trying so hard not to head to my phone the first thing in the morning, but that's how it works now. You need to take a step back, don't you?
Absolutely. Don't just rush into things. We do this every day. We work alongside our clients. So it's very important to speak to your advisors, people like ourselves, to make sure that before you rush to the exit, before you panic and press a button and there's no going back after that, rather put strategies in place. There are strategies that would reduce the amount of tax that you would have to pay legitimately, consider all your options before you fly, and make rash decisions, which potentially there's no going back from.
We should point out at this point, it's about avoiding rather than evading,
Correct.
isn't it?
And
That's
reducing rather than evading.
exactly right. You mentioned capital gains tax there for a moment. Why would you not just get rid of capital gains tax relief that non-residents it's applicable for certain non-residents who sell UK assets? That's been done before, hasn't it?
It has. As things currently stand, there's capital gains tax on the sale of investment property, for example.
Yeah, exactly.
Not your main residence,
Yeah.
but investment property. So there are taxes in place, and that's circling back to what I just mentioned earlier. Rather than knee-jerk reaction, put proper, robust plans in place so that you could take advantage of the reliefs that exist today before any changes come into place, and don't necessarily just believe the headlines and rush for the exit, because strategically it may not be the right thing for you.
You're thinking about this in some detail. This is what you do day to day. This is something that you obviously sit and kind of discuss and ruminate, and you take advice, and you come up with your own way of approaching your clients, I guess. Can I ask you to kind of not speculate, but just offer, put forward a thesis, if you like, the predicted kind of consequences of this, the concerns. What do you think, assuming this exit tax comes in and it affects you in your clients in some way, what do you think it means?
I think for the clients that take advice, I think it means it's business as usual. For you, don't panic. I think holding companies are a good option,
Hmm.
and certainly because of the way taxation is levied in the UK and the way that you can take out dividends, and make those payments to holding companies, and then from your holding company you can invest in a number of things, that offers layers of protection. So there are strategies there that will allow you to reduce the amount, or mitigate the amount of capital gains tax that you need to pay, rather than yourself as an individual, because you don't have that layer of protection in your individual capacity. So again, just highlighting the importance of taking robust financial advice.
Mm. We had a guest yesterday talking about personal finance, and I remember somebody saying to me years ago, fail to plan to fail.
100% right.
Which is, I know it's a cliche, and I know I've said it twice in 2 days, so I should probably do some more research, but it applies in this case, doesn't it? It's so important to think it through and to not just flail around worrying.
Absolutely, because there are anti-avoidance measures in place. There are other loopholes, if you like, that were closed a long time ago or are closing in the next budget. So it's really important to work with the experts and understand what the consequences of your actions are going to mean, rather than just, pressing an exit button and hoping for the best.
Yeah, and don't believe your friends are like, oh, it's definitely going to happen. Oh, yeah, there's no doubt. Oh, oh no, you got to sell that. Yeah, don't. Yeah. Last question. It looks likely that this is going to happen. Most observers agree. Rumors like this come from some kind of foundation of truth. But what if it is just a rumor? Is there a chance of a curveball here that you don't expect? I mean, again, it's a speculative question, but
Look, there's always a chance it doesn't happen. And I
yeah,
think business owners and entrepreneurs and investors in the UK will breathe a massive sigh of relief.
for sure.
But it's not to say that it won't be considered in the future.
Mm,
It just gives you more time.
okay.
So, time gives you an opportunity to plan and to put robust measures in place, and plan with the knowledge that it's a consideration today. It might not come in tomorrow, but there's no saying that it won't come in the future. And having proper financial plans and strategies in place is never a bad thing.
Mm. Because it wouldn't be the first. I'm kind of glad you answered it in that way, because it wouldn't be the first time that the Chancellor, and famously it's always the Chancellor outside in Downing Street with the box on the way to the Commons. That's always the picture. But it wouldn't be the first time that something long rumoured has not come into effect.
I agree, Tim, but I'm also cognizant of the fact that the government are running these models right now,
Yes.
and
Yeah.
they're briefing on them right now. So
I was
these,
looking for a glimmer of light, and you kind of switched all the lights off in the tunnel.
I'm sorry. But I think they have to look at as many opportunities as they can. So this is a good option for them to consider. Not saying it's the only option, but it's a good option to consider, because certainly last year when they brought in the changes for inheritance tax, those were big problems. How those affected the farming community and
Yes.
farms that have been in families for generations, and where they had some reliefs on inheritance tax, those were going to affect them that very day.
Mm,
And there was a lot of pushback,
there
but
really was.
and you saw farmers driving from far and wide and going into central London on their tractors, and putting demonstrations in place just to let the government know how disillusioned they were with those changes and what that meant for the farming community and for the very people that actually deliver food to your plate.
Yeah.
So that was something that wasn't foreseen and wasn't rumored before it happened. It just happened.
Mm,
And those people were really badly affected because they didn't have the opportunity to make any changes or to make any plans and put different measures in place. It was just something that happened, bam, on that day. So at least with having these rumors, it gives people the opportunity to sit up and pay attention and say, actually, I haven't done anything to date, but if this was to become a reality, what can I do
mm.
in order to set my camp up and make it as robust as I possibly can?
It's a hard thing to talk about, tax. It is, but you've managed to do it in I was going to say a delightful way. I've enjoyed talking to you about tax. I think it's the first time I've said that. I honestly think it is.
I know, Tim, thanks so much. Tax isn't meant to be taxing, but certainly it's complicated.
It is. Okay. The implications of the proposed UK exit tax. Michele Carby is a financial expert. She has her own practice under the Holborn Assets Group. They are a financial advisory, an international financial advisory. Very UK-centric story, I know, but November the 26th is literally around the corner. We will find out then. Michele, I've loved talking to you. Thank you.
Thanks, Tim. Thanks for having me.
Appreciate it.